You're watching Trading Hour. Joining in now is Pankaj Murarka, founder of Renaissance Investment Managers, who's going to talk about the market and also, where things look to be headed. Hi, Pankaj. Morning, and thanks very much for joining in. You're growth investors, right? So since this mid-June, where we have seen the market rally sort of take off, wanted to understand how much fresh money would you have deployed and in terms of these momentum stocks now, which are the supercharged areas?
Well, as investors, we generally don't take cash calls, so we generally by and large, always at all points of time, generally close to fully invested because of our positive view on the markets and the economy from a medium-term perspective. Having said that, we've seen a fair bit of new flows coming into our funds over the last few months, and that is what we have put to work. From a preference perspective, our portfolios are more biased towards pro-cyclical because what we are seeing is essentially the domestic economy continues to recover pretty strongly, and we're seeing strong underlying growth across various sectors of the economy, especially across sectors like autos and capital goods. Autos essentially because we're coming out of almost 2 years of constrained demand kind of environment because of supply side disruptions that have been prevailing in the auto sector and which has been improving very meaningfully now on a month-on-month basis. So we're seeing a very strong underlying growth in the auto sector as a whole. And we're seeing a strong recovery in capital goods sector as well. And that's primarily driven by, I think we're seeing strong signs of revival in private sector investment cycle. And this is where all capital goods companies have been recording very strong order intakes, and more importantly now it's translating into numbers in terms of revenues and profitability. So those are the two sectors which are looking very exciting at this point of time.
Pankaj, I was just taking a look at the mutual fund data which came out earlier this week, and the one which stands out is that equity inflows have seen a sharp drop in the month of July versus June. It's fallen by 42%, and if I look at that number, X of arbitrage and X of SIP, the inflows are actually negative, and that's happened for the first time in 18 months. What, according to you, explains this?
I would not read too much into it, Rima, because I think that's just a 1 month number or a blip probably, because what we've essentially witnessed is a very strong flows into mutual funds and equities from retail investors, and I think that trend continues. And in fact, all along the last 10 months when the foreigners were big sellers, I think the local investors were one of the big investors. So I think given the fact that longer term penetration of equities into household savings still continues to remain low, I think equity flows from domestic retail investors into equities will continue.
So, Pankaj, the point is that with the step up in discretionary spends, do you think that the incremental money which has been coming into the equity markets, either via mutual funds or direct stocks, do you think that might come under pressure? I mean, maybe you're right, this is just a 1 month trend. But do you think that going forward, it might sort of come into pressure, the retail money which has been coming in for the last 2 years?
No, not really, Sumaira, because the fact is household savings in India are very high, around 30% or odd. The fact is within the whole household savings, equities generally tend to get a very low exposure, and significant part of those savings are parked either into fixed income or bank deposits, real estate, and some of the other asset classes. As investors realize that over medium term to longer term, equity as an asset class can deliver returns which are far higher than other competing asset classes. And while equities could be volatile from a short term perspective, but from a medium term to long term perspective, in fact, the volatility of equity returns are much lower. I think that confidence comes back to investors, and I think this trend will continue because as it is, allocation to equities from the overall pool of household savings continues to remain low.
All right. Hi, Pankaj. Good morning and thanks for joining us. If I can dive into some more of these sectors, take us through what you think about the tech stocks. I mean, of course, we've seen how they've moved, but any of those that you would look to get into at these levels?
Well, we continue to own some of these IT services companies, and we still think that these companies can continue to grow at mid-teens kind of growth number over the next 3 years, because the fact remains that globally tech spends are on uptick and they'll sustain at that level for a foreseeable future. Because if you look at globally, all the Fortune 2000 or rather 5000 companies want to digitize their business. and companies, despite these fears of slowdown, they are not altering their tech spend budgets because that's become very core to their business. So as a result, we think Indian IT services company will continue to do well. More importantly, we are very excited about the internet as a sector. Meaning our overall assessment is that if you look at India's total internet economy, it's about $100 billion or thereabout. We think this can continue to grow at like 25% for the next 10 years, and probably India's internet economy can grow 10x in 10 years. So that's something which excites us quite a bit.